Okay, well, U.S. pension funds lost over 26% last year, and that has led some pension managers to move money into index funds. One of those managers is Bill Atwood. He's the executive director of the $9 billion Illinois State Board of Investment, and he comes to us now from our Chicago newsroom. Mr. Atwood, thanks very much for being with us.
Thanks for having me, Betty.
Okay, as we mentioned, your fund moved about $400 million into index funds from actively managed funds. Give us your reasoning for that.
Well, there's an ongoing debate about the utility of active management and whether, particularly in the large cap space, whether active managers can routinely beat the index. But beyond that, we really look for active management to provide us some downside protection in a rough market. On the other hand, what happened was just the opposite. In the sell-off that we experienced over the last 18, 24 months, again, particularly in the large cap space, most of our large cap managers were just unable to beat the benchmark. And so we were paying active management fees and getting basically negative alpha. So the decision was made to cut our losses, to markedly reduce the fees that we're paying, and then be confident then at whatever point in the future that the markets turn around, we'll be able to fully participate through these passively managed accounts.
How can you expect to outperform, your portfolio to outperform, if you're going to put more and more of your money into the index fund?
Well, outperforming isn't the critical issue when it comes to our equity portfolio. There's an old saw in our business. 90% of portfolio returns is asset allocation, and 10% is security selection. So the critical issue for us is getting the asset allocation decision right, and then being confident that the assets that we allocate to will perform in a manner consistent with our expectations. So before we go about trying to push the envelope and marginally increase our returns in the equity space, first and foremost, we have to be confident that the equity portfolio is going to behave in a manner consistent with our expectations so that the overall portfolio will behave according to expectations. Conventionally, we spend an inordinate amount of our time worrying about security selection, and it becomes a distraction to the bigger question.
Hi everyone, I'm Brad Steinman from Dimensional Fund Advisors, and I'm with Ken French, the Haidt Professor of Finance at Dartmouth College and a director at Dimensional. Ken, we're in an extremely volatile period for the market. In an environment like this, shouldn't active investors be well positioned to profit from activities like stock picking or market timing?
In aggregate, we know that the value-weighted average of all active investors can't possibly be particularly strong this period, particularly weak this period. The difference between a passive market portfolio and the aggregate of everybody else just reflects the difference in fees and expenses. There's no particularly good time for an active. There's no particularly bad time for active. Active's always going to lose just on the basis of fees and expenses. What do I mean by that? Well, basically what I'm doing here is using what Bill Sharpe called the arithmetic of active management. So suppose I hold a passive market portfolio. I know because the aggregate of all portfolios has to be the market portfolio, the aggregate of everybody besides me must be the market portfolio. I have the market, everybody else plus me has to add up to the market, so everybody else must be the market. Now what is my return? My return's just the return on the market, my portfolio, minus my modest fees and expenses. What's their return? Well, the aggregate of everybody else, they're holding the market again. It must be the return on the market minus their fees and expenses. But because they've got lots and lots of active folks in that bucket, their fees and expenses are almost certainly higher than mine. Essentially, the only way that this argument could break down is if somehow or other they were picking my pockets when I was trading. They're not. Okay? In fact, if anything, it goes the other way. So what do we see? We know that in aggregate, this passive market strategy has to beat the aggregate of everyone else. And by how much? Just the difference in our fees and expenses. Now, this is not a statement that over the long haul, I expect on average to win. It's not every 5 years. It's not every 3 years. It's not even every month or every day or every second. It's every instant. Every instant, I know that the return on my passive portfolio, my passive market portfolio, is going to be higher than the value-weighted average of everybody else.
Oh, if you buy equities across the board, which means an index fund, and if you do it over time so that you don't put all your money at the wrong time, and it's a low-cost index fund, that's probably the best investment that most people can make.